Susan is Senior Manager with the British Business Bank, and I will let Susan explain what the British Business Bank is all about and how we will go through this morning in the next hour or so there to just talk about all the various options that are available to help and inform you with everything that is going on. So thank you very much. Over to you, Susan.
Great. Thanks very much, Jane. And I shall just share my screen there. Has everybody got that screen? Following on from that, thanks very much, Jane, for inviting me again to just run through some of the business options. To begin that, I'll just talk about the British Business Bank, which is the UK's economic development bank. And we're here to try to help the markets work better, the finance markets, looking at where there's some market failures, maybe some market gaps, and looking at address those on behalf of government. Our mission is to help business growth across the UK, and underlying that is also a transition to net zero, but it's looking at improving the landscape for finance for smaller businesses. So in terms of who we are, where we sit in the market, as I mentioned, Economic Development Bank, wholly owned by government, but operating independently. So we are arm's length from government, but working, delivering and managing some programmes on behalf of government. Important to say that we are not a lending or investment bank. We're a non-regulated bank, so a reminder that we don't provide advice. We're not here to advise you on particular products or financial services companies. We're here to support and help you explore finance options that could help you grow your business. So the British Business Bank, being not regulated or licensed, doesn't generally lend or invest directly. We work alongside over 200 partners who are accredited to deliver finance with some support from us. And that enables the markets to deliver more because they have some underpinning finance that may be provided by us, both debt and equity. And I'll come on to some of that in due course. So in terms of our overall objectives, we're looking at helping businesses grow, smaller businesses. Our focus is very much on the smaller business market. Driving sustainable growth, and sustainable in that context is good growth. So businesses understanding and finding the right finance for them according to what their individual plans are. Backing innovation is more the investment arm and tends to go with sort of those tech, science, innovation-led companies, and that might well be equity there. Unlocking potential references the fact that we also have our part to play to make sure that businesses, whatever gender, ethnicity, location, stage of business you're at, you can find the type of finance that you might be looking for that's right for you. And I mentioned about underpinning of the green economy. In terms of what we're doing is bringing expertise. We publish lots of reports. We're looking to understand the markets, and we provide money into the markets as well, either to co-invest with equity providers or to underpin lending through guarantees and securitization of finance. So we're crowding in effectively the private sector alongside public sector. We work with a whole load of finance providers. Many of those you'll recognise, many you might not, and that's not an exhaustive list. I mentioned there's over 200, so they wouldn't fit on the slide, but that's a snapshot of just some of the finance providers that we work with. So that's looking at where we are with the British Business Bank, but the important thing for today is to talk about different types of funding for your business. So today we're looking at covering funding with non-dilutive funding, grants and debt finance, aiming to improve your knowledge of the funding landscape and explain also where you can get additional support and information. In terms of what we'll cover, an introduction to the landscape as it is, types of business finance, preparing your business to apply for finance, and some further signposting at the end of that. So The finance broadly fits into three categories: grants, debt finance, and equity finance. Today, we will be focusing on debt and equity finance. But before moving on, just a few words about grants. They may be available, smaller local grants from district borough councils, as well as others. And some are available to reduce your carbon footprint, for example, or larger grants that may be available from the likes of Innovate UK. In terms of business grants, I think one thing just to bear in mind is to consider carefully the application for those grants and how to make your grant bid as compelling as possible to tell the story of why and how your business can make a difference. And make sure that somebody else with some experience of grant bids just reads through your application to check that everything is telling the story as you wish it to be told. One thing to finish up on grants is to make sure that if you're looking at grants, they fit with your business and not according to what the grant is trying to achieve. It is a false economy to sort of chase grants, because your business will be taken off into directions that you wouldn't necessarily want it to be taken. So really bear that in mind. But I'm not going to focus on grants. There are other people who are better placed because to talk about grants. So in terms of debt and equity, that road to investment, if you like, is a interesting, complex, complicated one in some cases. And some of the points noted here may seem obvious, but it is always good to just consider what you need to do to have a clear mind and to be able to articulate what you're doing and say it in the right way according to the audience that you're talking to. It's really important to evaluate your ambitions. What are you trying to achieve? How much funding you need? What your roadmap is. Company structure also may be relevant. If you're a sole trader, then invariably there will be a personal loan in place if you're taking out debt. If it's a limited company or another incorporated company, then more of a business loan. So some of those factors just need to be understood, and we'll come back to some of these points. And also, you probably don't need me to tell you about the fact that your financials need to be in place, robust. They will stand up to scrutiny. They will be realistic as well, because if somebody dives into that, they want to know that you've got all angles covered. And importantly, also, are you missing any key skills in your management team? And that might well be on finance and interim part-time finance directors are increasingly popular, just to get some of that strategic perspective, even if it's only for a short time in your working calendar, is actually to get somebody that can just talk through and be play devil's advocate sometimes in terms of what your plans are. So moving directly into types of debt finance. And we'll run through here some of the terminology, some of the products, some of the core characteristics. So for debt finance, the core products, if you like, or types of finance that are available from a number of finance providers are just noted here, including term loans, commercial mortgages, asset finance, overdrafts, and other like invoice finance and HP. And one of the reports, just to add to this, one of the reports that was published a couple of weeks ago by the British Business Bank highlighted that I think it's nudging 60% of loan finance is actually now going out from non-mainstream providers of finance. So there is a whole set of provision that is out there that you may not be aware of. So one thing to think about is, if you are looking for any of this type of finance, is there are so many providers these days, is actually trying to keep track of who they are and what they deliver. So the characteristics of debt finance is that you're retaining ownership of your business, unlike equity finance, and the repayments, you can manage that over time and determine at the outset the term loan, the period of repayments, You can potentially look at how the different types of loans are looked on fixed and variable interest rates. Personal guarantees might be asked for. So it's really very open to discussion with a provider. If you don't know what type of finance might be right for you, then a finance broker, an independent corporate finance broker might be somebody to talk to. But that's not for me to say, but it's just, if you're not completely sure, make sure that you understand the breadth of options out there, because there are many, and I'll come on to some of those in due course. First of all, right at the beginning of the journey, and I know there's some early stage companies on the call today, startup loans are government-backed loans, which are personal loans for business use, and that's a really important factor to consider here. These have been in place for 10, 12 years now, and this is one example of the British Business Bank managing a programme on behalf of government that looks to address a gap in finance provision, and in this case for early stage businesses. So with this one, you would be able to, according to meeting all the eligibility requirements and everything else, which you can look on our website, is unsecured personal loans of up to £25,000 per business founder. So if there's more than one person, potentially you could get up to 4 loans of 25,000, so it's 100,000, and that might work for you. But one thing to bear in mind is, through that application process, a personal survival budget will be looked at, because if your business doesn't grow the way that you think it's going to grow, with the way you're forecast, you will still be liable for that loan. So there's quite stringent scrutiny for how you might be able to pay back the loan if your business doesn't quite go to plan. So some lenders might look for a minimum trading history, but in general, there are providers out there that will be looked to supporting pre-starts and very early starts. And you would need to go through the normal checks of having that business plan open to scrutiny to investigate whether your forecasts are being realistic or not. The British Business Bank works with the Open University, and alongside the startup loans, there's a whole suite of business learning courses that are open and available. And whilst they're set out under the startup loans part of our website, that they are, I think, really relevant in your early years. It's not all about finance. Some of it is just the business planning, the strategic planning, marketing, just understanding in some of the employment activities that you need to make sure that you're on top of in your own business. So that's startup loans right at the beginning of the journey, and they will be available because you may be unlikely to secure finance at that early stage from mainstream finance providers. Overdrafts, many of us are familiar with these from personal finances, and they're looking at borrowing to an agreed limit to manage the ebbs and flows of your business. So the advantages of these are that you can be flexible and you can manage variations which might be seasonal. If you're a gift business, then you might have a few peaks that you need to manage stock for, and an overdraft may be appropriate for that. The disadvantages there, they may be repayable on demand, which means that you are potentially vulnerable. But again, that's something to look at depending on who your provider is. Interest rates can be variable as well, and depending on the size of your overdraft, security may well be asked for. But I think overdrafts need to be used for the right reason, and I think that's really important, that it is when your business, as I say, is ebbing and flowing. It shouldn't be seen as a longer term finance to secure there. Moving on to term loans. So term loans, there's more structure to them. It's a more considered lending to for a particular purpose in your business. It might be for working capital requirements, if you need to manage stock and pay for stock, and if you're growing, the cash that you might need in the business might well mean that you need to take on some extra cash. If you're employing staff, then before the business ramps up such that you're selling products and the profits are coming back into the business, you may well need that. But don't forget as well that term loans can be used to invest in new invest in your business, and it isn't all about using debt in times of crisis. And I think that's one thing that we know at the British Business Bank from the research that we do, is that businesses, when times are difficult, which there's no doubt about that they are at the moment, is businesses are quite cautious about taking on external finance. But it's a matter of understanding what might be right for you. So if you're doing something that has a long-term payback, then term loans, business mortgages on property might be something for you to look at. It's likely to be secured against assets or against a guarantee on the business or a debenture. So again, that's something to bear in mind in terms of looking for the right terms and conditions according to your own business plan. Asset-based lending, I think, is something that can be overlooked, and asset-based lending is looking at utilizing the assets of your business, if they're appropriate and relevant, to as collateral for bringing in finance to your businesses. And assets can be physical or intangible. If you think about intellectual property, if you're a science or innovation or tech-based business, you may have patents and other underpinning intellectual property that you might be able to borrow against. So that's looking at something that might be able to be liquidated if the business fails to meet its targets. The disadvantages, the flip side of what I've just said there, is that if you default, then the finance provider may well be able to take back the assets against which that loan is secured. And the likelihood is because there's like a resale value on assets, is that they're likely to be valued at a lower price, lower cost than you may have paid for. But I think this is overlooked, and is something definitely that you might be able to look at. And it isn't just all about buying new assets. It might be assets in your business already that you might be able to borrow against. In terms of invoice finance and factoring, some people have sort of overlooked, again, this as a line of finance, and both invoice finance and factoring let business owners collect invoice payments up front without having to wait to receive payment from your customers or your clients. So this is real advantage for cash flow, and it sometimes is particularly relevant where a smaller business has larger corporates or larger businesses as customers, because there can be cases where large businesses, they might be good for their payments, but they might take a while to pay. And I know we could all say that that's something that we wish didn't happen, but I hear many cases where it does. So if you're looking at financing your invoices, then you can get that the payment within your business to oil the wheels of your business more quickly. Factoring is slightly different, or is different to invoice finance, as the payment will be collected by that factoring company. So effectively, you're selling your sales book to a third party, and that they're managing that process for you. So it's not such a private, confidential process. It becomes visible that you might be using another third party to collect your debts. Not necessarily a negative, but just for you to be aware that that's something and that you need to be mindful of. In terms of other types of debt finance, I'd be interested to hear if anybody else has used any of these. But peer-to-peer lending, the landscape for this has changed hugely over the last 5 or 10 years. And peer-to-peer lending, there were a number of fintech portals that were created. Funding Circle was one of the first. And that has changed from being that peer-to-peer to be more institutional lending, but there are other peer-to-peer lending sites. And for this, it's not really for me to say what is appropriate for what type, but there are a number of platforms that you need to do your homework and ask your business peers, ask the people that you're connected with, just to see whether they can make any suggestions about what might be right for you, because different platforms will have different sizes of loans that they might offer. They might be secured, they might be unsecured. And the other type here, which is really important, is if you're looking to trade internationally or you are trading internationally, then UK Export Finance is one of the organisations that is designed to help UK businesses sell overseas. And there's a huge amount of information available on their website. And if that's something that might be appropriate for you, if you're thinking about that in terms of bonds and guarantees and letters of credit and all of that, in terms of making sure that you can protect yourself against bad payers for internet or delayed payment for international trade, then UK Export Finance, and also talk to your mainstream bank as well and other lenders, because there's appropriate and relevant ways to make sure that you can manage your international trade appropriately and less risky, more importantly, really less risky. So just at that point, before I move on to equity investment, does anybody have any questions? That's a really quick run through with lots of different terminology, much of which you may already be aware of, but very keen to just open it up to any questions, or I can carry on. Jane, you haven't seen any questions in chat, have you?
I haven't seen anything in chat at the moment, so
okay.
So I would suggest that we move on.
We'll move on. We'll move on. And if you have got any questions, please put your hand up. And if I don't see it, then Jane will flag it to me as well, because I'd like to make sure that you get your questions answered as well on this. But I think, again, just to reiterate, it's just pushing out there some of the phraseology and some of the terminology that's used in the finance markets that you may or may not be familiar with. Much larger companies, and I know there may be one or two on this call, will have gone through this process. So if there's any tales, shall I say, to tell from your experiences, then happy to hear those and perhaps share with others on the call. So the non-dilutive funding that we've just talked about, which means that you're not selling any equity in your business, that is debt and loan finance and another finance. Moving on to equity investment, that's looking at finance whereby you're selling rather than selling a stake in your company. They're not mutually exclusive. Having said that, if your business is expecting high growth and has the ability to be scalable with a large potential market, then it might be that you have some equity finance brought in and some debt finance for working capital. So I think increasingly it's a mix of finance is used by many businesses. So in terms of thinking about equity, selling equity in your business rather than funding it by debt, this tends to be those businesses that are scaling up. Technology, again, tends to be that rather than services businesses, because they can scale much more quickly. And economies of scale can be factored in through technology. And the sources of investment go right from the beginning, what I probably should have put up here, sort of friends and family might be, and that includes your own savings, is putting your own money as investment in your business, such that you're taking a stake in your own company, as opposed to living off your savings separately. And with that, it's really important to take guidance and advice about how best to position your balance sheet with equity investment, whether it's yours or other people's. So beyond that pre-seed, early stage startup investment, we move into business angel finance, venture capital, private equity, right through to IPOs, initial public offering, which fewer companies use that as a source of raising capital, but for some it is appropriate. So the characteristics of equity investment is that an investor is buying a stake in your business. And at those earlier phases, business angel and venture capital, an investor is bringing more than money. And that's a really important thing, because it has to be a two-way street. Expertise on your board, networking opportunities, potentially if it's somebody who's got a lot of experience in a particular sector, there may be introductions to new customers. It really depends. And if you're looking for equity investment, then it's important to understand what type of investor you'd like. Are you looking for somebody to add a functional skill? It might be finance, or another skill such as sales, marketing, technology, and somebody who really understands your market, or international trade. If you're in a science-based business, then that might well be the real sector expertise in terms of how to scale up. So it's really, I think it's important to understand what you're trying to get out of it, and certainly don't think of it as a one-way street. Think of it as a two sides of an equation, because potentially an investor coming into your business, it's a long-term relationship. And somebody said to me recently, it's sometimes easier to get divorced than it is to extricate yourself from some complicated equity investment. But I won't cover off any of that. I'll leave that to some other professionals on that one. So in terms of what type of equity investor, the age and stage of your business is really important to look at. And it is generally more challenging to get equity funding for business to consumer businesses rather than business to business. But with all of these, there are exceptions to that. And it's really getting to understand what you want out of it in order to understand what might be right for you. Because that relationship might last between 5 and 10 years. So you also have got to get on with the people who are investing, whether it's the mentoring or the expertise that comes with that. It will be a time-consuming process. And what I've heard from the markets recently is that where going back a few years, it may have taken 6 months to secure some equity finance, it might take 18 months now. So it is really important that you manage this process in good time. You have your plan of action. You know who you're asking, and you need to look at who might be best placed to work with you. So that angel investment, you're looking at potentially somebody to work with you for a long time, as I mentioned, but the disadvantage is there that you really need to make sure that you demonstrate your proof of concept before going out. Otherwise, valuation potentially is compromised, and you also understanding the longer term consequences of selling shares. If you have multiple rounds of shares, then your own stake will be diluted there. So absolutely working with a finance advisor or an accountant to look at that dilution and understand what your share capital table might look like as you're going forward. But they also a stake in future profits is something. So you understanding whether it's right for you personally is something to think about. Moving on to venture capital, this is still venture, so this is still the earlier phases of growth for your business, but potentially larger injections of cash, often without taking a controlling stake, but a more substantial stake. And some of that venture capital money, there may well be representation asked for on your board. And this can be a positive, but you might see it as a negative if people are looking to help you determine your strategy, questioning your own strategy. But I think that's really important. Somebody to have that wise challenge, and if you're looking at scaling your business, that challenge will often stand you in good stead to just be able to respond, because you'll need to respond to future investors if you have that whole process mapped out in terms of how you might finance your growing business. Think about some of the fees that might be involved. Think about some of the legal aspects of putting all of your shareholder agreements in place, and this is relevant for anything to do with selling your equity. I know of too many examples where shareholders agreements, articles of association just don't represent the right thing that founders might want as a business grows. And one example I know from many years ago, before I joined the bank, is I was working with a business who was looking to sell some equity, and to cut a very long story short, it turned out that they didn't actually own the equity they thought they owned, because the right documentation had not been filed in terms of Companies House and everything else. So they didn't have the equity. That got sorted out before they actually went out to any venture capitalists. Otherwise, they would have been exposed at day one, which is not what you want. So other types of equity finance, private equity is moving into institutional money. And this might be pension funds, it might be insurance companies. It is that more institutional. So they will be more hands-off, not necessarily looking for any advisory or observer seats on the board. They might take a seat, but that's something to look at. And potentially larger investments suited to mature and growing companies. So that's private equity is really moving up the line more. And then at whatever stage, crowdfunding comes in. And again, this market has changed a good deal over the last few years. But if you're looking at this, make sure that you're looking at a regulated platform, and also you need to make sure that you have some revenue to tease, to prompt, to whet the appetite of investors. It's not as it was when these platforms were first set up, that you could put your proposal out there and say, I'm looking for however much it might be, 10,000, 50,000, 100,000, without having any other investment secured. Now you would be looking at sort of topping up on crowdfunding. So you'd need to make sure that there is investment in place already. If you think about how you would view this, if you were investing in a business, if nobody else is investing, you might hesitate in terms of whether you would invest. So it can be pre-revenue through to more established, and the different platforms will focus on different things. But if you're looking at that top up, if you're looking for not the whole investment round, then they can be a quicker way to raise finance. I think one thing to bear in mind in all equity is just to dig around to understand what the right networks are to get into. whether it is sector, whether it's stage of business, and to look at some of the membership organizations that to make sure that you can try and understand what type of investment the investor is looking for. For business angels, the UK Business Angels Association website, and I cover the Southeast, and all of the angel groups and syndicates that I work with are members of UK BAA. There will be some that are not. So it's just worth just understanding that. For venture capital, the British Venture Capital Association will be able to give you some information as well about the organisations that you might be approaching. So there is a host of potential sources of equity finance, as there is with loan finance and debt finance. And moving into why certain things will be useful and to help you understand what might be right for you. And the markets are moving in terms of the appetite to risk. That is changing all the time. We've moved from a place of there being lots of equity capital when interest rates were lower, and now some investors are thinking, well, I can invest my money and get a return on the markets, as opposed to a risky investment into smaller businesses. So we've seen a reduction in equity investments in the Southeast. There's been quite a substantial reduction, 30+% over the last 12 months. And there is another characteristic that to be aware of, is that there have been fewer investments, but the value has not changed so much. So there's bigger investment rounds, but fewer of them, if that makes sense. And I think that is thinking through the appetite for risk is certainly in angel and venture capital. If a angel or VC has a portfolio of companies and some are doing well, they may be more likely to follow their own money into those businesses rather than take the risk, which is not what you want to hear if you're an earlier stage business trying to raise capital for the first time, because there is more scrutiny, that it's taking longer, and investors are taking less risk than they were a couple of years ago. So looking at the mindset of investors, lenders versus equity, if you're borrowing money, going back to the discussion that we had about all the various sources of loan finance, there's valid reasons and lots of positive reasons to take a loan to grow your business. But an obvious question for that one is, what happens if you can't pay? I mentioned about startup loans, which is a personal loan for business use, and a personal survival budget. If your business idea doesn't go to plan, or worst case scenario fails, then you will still be liable for that loan. And the same with a business loan. What happens if you can't pay? So your financial plans need to make sure that you can service that loan, and you've got a plan in place for your revenue and profits that reflect that. Have your numbers been tested and challenged and work through scenario planning and the like? And as we saw in the times of the pandemic, how agile is your business? Can you change course? Can you bring in a new product or a new service for shorter term income to mitigate some of that potential gap? So it is a very different plan to put together, financial plan, business plan potentially, for borrowing money than it is for selling equity in your business, because an investor wants to make sure that they know how they are going to recover their investment in you with a gain, and that gain might differ depending on who they are and what their expectations are and how patient they might be in the market. Some people are quite happy with thinking about being a patient investor, but they still want to know what their exit route is. And is the founding team the best team to be in place? I was talking to a venture capital company a few weeks ago, and I was in when I was talking to her, she was one of the investment directors. She said she'd just been on a difficult call with a client because the founder was not the right person to take the business to the next stage. So they were having that difficult conversation of looking for, or another person in the business, it may have been, I don't know the details, of looking to make sure that the right person is leading that company into that scaling company. So the people who are starting a business and growing it are not necessarily the same people who continue that scaling growth journey, especially if it involves rapid scale and international trade as well. So with all of this, you need to demonstrate, and this comes back to sort of standard business planning, is what problem are you solving? What are you bringing new to a sector? You know, is the business truly scalable? Some businesses are scalable, some are not. And investors will look for those that are scalable. And by that means investment in is more than a proportionate return back. So just the last few slides that I'll go through before opening up to questions is just I suppose a recap and a reminder about some of the business basics that, however much they're talked about, and Jane and her colleagues will talk about these all the time, it is just good to take a sense check and make sure that you've got these in place. Is, I mentioned just now, understanding and explaining clearly what the problem is, where the gap is, and how you're solving something differently to someone else, and what are the resources that need to be in place in order for that to happen. How do you measure your business and whether it is performing as you expect it to perform? In some businesses, it's sales. In some businesses, it's profitability. It might be, you know, key performance indicator in stock turns if you've got a fast moving product. But you know, how that business is measured is really important. So what the funding will be used for sounds such an obvious question, but are you creating a prototype to demonstrate the product or service? Is it just that minimum viable product to get something out into the market, to test it with real customers? There may be some collaborative work to do with customers on that. And when do you start trading? Again, that sometimes you can try to refine and perfect, in your view, a product or a service, when actually what you might need to do is get it out into the market and look at some of those early trading to inform you what's happening in the market. Business plans, they don't need to be tomes. They need to be something that you can have as a reference tool for your own guide as to what's happening in the business. Your core products, your core goals, what skills you might need today, short term, mid-term, longer term, how you might price your product or service in the future. How do you maintain that resilience and ability to switch course if it's necessary? And really important, and it's at the bottom of the list there, but it's really important to make sure that whatever you can protect, whatever intellectual assets you can protect, you do that as early as possible and take some guidance on what is protectable or what should be protected. It isn't all about patents. Some of it is making sure that if you're a software company, you do the right thing by your natural copyright rights. So that some of that is just taking guidance about what's there. In terms of the financials and what you'll need to know, the standard P&L, cash flow forecast, understanding your working capital requirements. Can they be managed by an overdraft? Do they need a longer term loan if you're investing for growth? just understanding all of that and pushing those metrics and putting some scenario planning in place is an important thing to do there. And this is where taking sound financial guidance is really vital. Studies show that it moves around in terms of the statistics, but 70–80% of the UK business failures are because of cash difficulties. So that is really something to make sure that you don't succumb to. You will, if you're borrowing money, you will come under some credit assessment processes. And for all financial products, they will check your business for eligibility under certain characteristics. They'll look at your credit history, your ability to repay. Bear in mind that any investigation to do with assessing your credit worthiness might affect your credit score. So understand where you are, what you are, and some of those key factors that could affect your ability to borrow money. There's hard searches that might be carried out, and as well as softer searches. So a bank is essentially exercising its judgment as to how likely it is that you will repay the money that's lent to you. Individual banks are going to have different terms, but the major areas for consideration will be similar. And guarantees, personal guarantees from directors may be needed. Individual lenders may be different to business lending. So I'm drawing to a close here in terms of what I'm going to be talking about, but further help and guidance, as well as Jane, I know, will come back on some of the support through the Growth Hub and the growth programs managed by Buckinghamshire Business First. But there's a whole host of business articles and information to help you understand what you need to know about finance on our website, Business Guidance. It's not, I mentioned right at the beginning, it's not all about finance. Some of the startup loans courses talk about employing people, just some of those business essentials, increasingly how to reduce your carbon footprint, so the sustainability piece, looking at supply chain, marketing, and just managing your business more effectively. There is a host of information out there, and you will get these slides afterwards. So there's some links there, and some of those refer to some of the membership organisations. I mentioned UK Business Angels, the British Venture Capital Association, and a reference point for finance brokers. The National Association of Commercial Finance Brokers is just one of those organisations. There are others that brokers may be members of, so trade organisations. So that is me for now. To reiterate that it was such a quick run through, but is just raising awareness of some of the terminology. If you've got 2 minutes just to ask 2 questions. One says, are you better informed? And the other one says, might you take any action as a result of this? But that's it from me. I will open this up to any questions and have a drink of water.
Susan, thank you so much. That's been really informative. Lots of information there for whatever stage of business you may well be at. So thank you so much for that. I don't know if you just want to stop sharing there for a moment. There is one question in the chat that I've just held off. Are there any advisory mentoring that we can seek about different options and statistical data available to help ascertain what's the right investment option for us? With my experience, US investors are very different to UK or EU.
Oh, there's a lot in that question.
I was going to say that's
there's a lot in that question. I think you're right to be asking about looking at taking guidance about this, because depending on what you're trying to do, there may be different approaches. And also you are right about different experiences with US investors. There is perhaps more risk taken by US investors than UK. And I'm reflecting on conversations that I have with investors. It's not anything to do with what the British Business Bank does in terms of its investment. Once we are working with a partner, all of the investment decisions are fully devolved to those partners. So some software companies have been, I know, have gone out to the US to look at investment. And some of it is just a matter of scale. When businesses get to a certain scale, there are fewer British and UK investors that have that finance in the market. So I think there is some work that you can do yourself in terms of understanding the likelihood of what's available and what different investors are looking for. The statistical data, I think that's an interesting one. It probably there is a lot of angel finance. That is the biggest amount of finance, but making sure that you know what investment is appropriate for which type of company, I think is perhaps the way to go on that one. But look at going to networking events, hook up with some of the angel networks, talk to them directly. They're all quite open. And I think just dipping into what's what. We've got an event. I'm on one of the panels at one of Innovate UK and Buck's Business First event on Thursday this week. And there's going to be, we're looking at financing for innovation. So there are more specific environments where you can talk directly to people to try to do this. In terms of the, oh no, that was about US investors as opposed to overseas trade, because I noticed Craig is on the call and wondered if he wanted to say anything else about overseas trade and finance. But won't put you on the spot, Craig, but that was more on US investors. But yeah, it is a different landscape. I'm not sure if I've done that justice, but it is a bit of a big question.
Yeah. And we also have
FD
another
services.
question there.
I'm not sure about free. I think there's guidance about what's needed in terms of putting together a business plan. You can find templates and toolkits to put things together. But if you need finance director and legal services specific to your business, you'll need to pay for those.
Yeah. I'm not aware of anything that is free for a startup business of that nature, or any type of that, I would say.
Mark, you've got a question.
Hi, good afternoon. Just a quick one. Is CSR a method for funding if it's environmental business solutions that affect that company directly?
You mean if somebody can present that as the case for why they need investment? Do you mean? In some cases, it might be. There is more focus on finance to reduce carbon emissions and to green businesses. Again, it's a matter of understanding what you're trying to achieve, because what you want to avoid is any greenwashing of the presenting finance, and actually it's no different. And in some cases, it's making sure it's got a good business case behind it. Like, you can reduce your energy costs because you've invested. That's
or I've got a solution as a result of something you've done.
Yes, exactly. Yes.
Okay.
And on just one thing that, not specifically answering that question, but one thing that I will just talk about is another line of finance which is becoming more prevalent, is through community development finance institutions, and CDFIs are impact-led investors and looking at where traditional mainstream finance may not be available. There is another line of finance there, and they're looking at understanding your business and being more projection-led funding for smaller amounts of funding. So if you put community development finance organisations in, if you haven't been able to secure finance through traditional routes, there may be another option if you can present your story and present your case. So that is just one thing that I didn't mention earlier.
And Mark, if you drop me a line on that, we could also, I think we've got some one that falls into that category, Susan, that we can signpost you towards, Mark.
Oh, that's great. Well, I'm going to meeting on Thursday, so
okay,
if everyone's there, I'll look forward to catching up with you then.
Okay, thank you, Mark.
No, I'll be there. That will be an in-person.
Brilliant.
I'm doing one of the breakouts, so you'll probably hear me talk about some of this stuff again.
Right.
If you're there.
Yeah, look forward to seeing you on Thursday. That's fantastic.
See you there, Mark.
Thank
you. That's in. I'll do a bit of a plug there, Jane. That's in High Wycombe Wanderers Football Club.
Absolutely. Yeah, it is.
From 10 o'clock, I think, through to lunchtime. And there's a number of different breakout groups, Innovate UK and others. And I'm there just running one of those.
Yeah. It's about helping people understand what are the options regarding innovation and funding. Just talking about that. It's in person, so do look onto the BBF website as well, so that is there to do that on the 20th of March.
We've done our time here, Jane.
Absolutely.
I think I need to get you to wrap up.
That's right. Are there any other questions at all for Susan this morning?
If anybody does have any questions, I'm just going to, it's on the slides that will be coming out to you, but I'll just put my my email address just in the chat there. But bear in mind that we're not a regulated bank. I can help guide you to some information, but I can't directly introduce you to any finance. Yeah.
And finally, so thank you very much. If there are any other questions, then do drop us a line at BBF. Just to take 2 moments of your time. If you've got any business issues, do take a moment to scan that QR code. It takes you to a brief questionnaire, and the government have asked the growth hubs equally to promote this to businesses, to get businesses to give indications of what else could be done to support the business, your business growth and productivity. So if you need a burning, have a desire to put some comments in that will go to central government, then please scan that QR code now and complete the questionnaire. So that does give you that opportunity if you want to do that. And if you have any general queries, then we are here. You can email us at businesssupport@bbf.uk.com. But finally, I would very much like to say, Carol, Susan, thank you so much for everything that you have done this morning. It has been a great morning, great opportunity to actually share for the last hour with some ideas about finance. So I would really say thank you so much, Susan.
You're welcome.
A lot of information there, and hopefully it's been relevant to people here. And if you've got any further questions, then do come back to us and ask, and we will try and get either Susan directly involved or be able to help ourselves. So Susan, thanks once again, a great hour, lots of information, and thanks everyone for joining us here.
Brilliant. Thanks very much.
Thanks very much, Jane. Thanks all.
See you all soon.